Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. What a week. What a show. 3 great articles amidst this Federal Reserve rate dropping environment. 3 good ones. First one we're going to look at is from CNBC. It's headlined, "Young, Rich Investors Are Making 2 Key Mistakes," says CFP and financial psychologist. They'll learn the hard way. Bum, bum, bum. Next article, "The Number 1 Way Americans Are Becoming Millionaires." Subheadline, "The best investing may not always be thrilling." Ooh, it's thrilling to us. And then we close. Yes, we have a Wall Street Journal article, our only one of the show, headlined, "Where to Put Your Money After the Fed Rate Cut. What Lower Rates Mean for the Trillions of Dollars in CDs and High-Yield Savings Accounts." So it's timely because the Federal Reserve cut 0.50% on their rate. So it matters because it affects what's going on in all these savings accounts and all these mortgages and all the rest. So let's start off at the top. This is a CNBC Make It by Ryan Ermey. "Young Rich Investors Making 2 Key Mistakes." What are they? I found this article interesting and affirms the podcast you're listening to. The article explains, if you're looking to build wealth, traditional forms of investment aren't going to get you there, at least according to young rich people. Of those aged 21 to 43 with at least $3 million in investable assets, just 28% say it's possible to achieve above average returns with stocks and bonds, according to the 2024 Bank of America Private Bank Study of Wealthy Americans. Ugh, what a mouthful. Now check this out. Among those ages 44 and up, the inverse was true. 72% say classic investing practices work just fine, and 84% of the older generation views stocks, domestic and foreign, as presenting the greatest opportunity for investment growth on a long list of asset classes. So I found this interesting because I'm curious if we took the snapshot over 30-year periods going backwards, if this would still ring true. The data's so fresh on all this that I don't know if we could go that far back, because most Americans 90 years ago did not own stocks at all. I think it was 10% of the American public that owned stocks in 1929, some really low percentage. You oftentimes look at the Great Depression stock charts and think, oh dear, that must have affected so many Americans directly. Well, not directly, certainly indirectly. It was symptomatic of a broader economic malaise, but it was actually not that many people own stocks. Nowadays, a lot more people own stocks. So I find it interesting. Older generations are saying, no, you can still keep your investing simple, your time horizon long, your costs low. That's the key. It's the younger folk, which they're defining 21 to 43 as young folk. So some of my listeners, you're just skating into that young group. You know who you are. One of our listeners turned 41 today. He's been a guest on this podcast, so he's still in the younger cohort. The article explains, though, owning stocks has been a wealth builder for generations of America. It's with the broad market returning 10% per year over the past. So what they do in this article is they show the divergence between the younger generation and the older generation on what they think will get them over the financial finish line. So Mr. Brad Klontz, a CFP and a professor of financial psychology at Creighton University, thinks the older generation has something to teach the young ones. The greatest divergence, no surprises, in crypto, where the greatest potential for growth, 28% of the young ones think it can happen, 4% of the old ones. Yowzas. Personal company or brand, 24% of the young ones thought it would work, 6% of the older ones. So you definitely get divergence. Now, I find this interesting. Emerging market equities. 16% of the young ones think that can help you. 25% of older folks. A lot of this, guys, is just recency bias. So you just Emerging markets have been bad lately. So in your investing lifetime, for the last 10 years, emerging markets have been terrible, really since 2007. Be careful about those recency biases. And this is domestic equities. The older generation, 41% think it's got a great potential for growth. Just 14% of the young ones. 14% of the young ones. So let's be mindful. Your host here is considered a young one, but I am with the older folks on this one. Now, I don't always align with the older folks on issues of the day. We have many older folks who listen. They know very well that I can disagree about this, that, or the other. But I will say this. I stand with that 44-plus crowd. I am in alignment, in solidarity with you. I think the young folk would do well to listen to you. Now, this gentleman, Mr. Professor Klontz, Brad Klontz at Creighton, who's a professor of financial psychology. Ooh, I would actually like to take his course. I'd like to be a financial psychologist. I sometimes think I am. So Klontz says, the desire to push against conventional wisdom is a really important development stage. Young people on social media tell me that traditional investing advice isn't the way it's done anymore. Everything's changed. This is something that people have been saying for thousands of years. So Professor Klontz is correct. Klontz even gives a bit of a testimonial. He said, if you asked me that question in my 20s, I might have said day trading. Just before I lost all my money day trading. So he says when it comes to some of the tried and true approaches to investing, it really is a long game. Klontz says when I hear about people talk about crypto and alternative assets, that's much more of a short game mindset. They're probably interested in real estate, private equity deals, direct investment in companies. Be wary, he says. Be wary. He taps in so well into this. He alludes, he says, these investments must be better than the stuff everyone can buy, these private deals for accredited investors. Otherwise, it wouldn't be so tough to invest. He actually says, hey, the index is the way to go. He says that while the data is mixed on whether private equity funds tend to outperform public stocks over the long term, you'll generally have to pay an exorbitant fee of the privilege to invest in one. Often 1.5 to 2% of your invested assets per year plus 20% of your annual profits over a certain threshold. So doesn't mean these investments can't do well. You just want to put the probabilities in your favor. Professor Klontz rightly identifies, it's as if he listens to this very podcast, cost matter and what you can sustain. Permanence matters over the long pull. And if Professor Klontz, the psychology professor of finance, tells you, yeah, I think the old folks are right, we would do well to listen to our elders, would we not? So listen to those elders. We have a great Morningstar article. Danny Noonan, Morningstar, headline, the number one way Americans are becoming millionaires, the best investing may not always be thrilling. Yeah, that subheadline sucked me in like a tractor beam. I had to click on the article. I had to talk about it on this podcast. Because these sorts of articles don't always get the coverage they should. So, the article begins. Patience and discipline are easily understood but hard to put into practice. You think. Understatement of the year. Investing serves as the perfect litmus test. One could reasonably argue these two traits are among the most important factors. I mean, it's just true. So I think this data is interesting. It can be very difficult at times to get excited about tried and true investing. Boring investing. Hammer, nail. Do it for 50 years. I've lost half the room already. But Fidelity, sometimes it's nice when data comes out. Fidelity came out with a research report that showed they had more 401k millionaires on their platform than ever before. So the growth was alarming to me. And I don't mean alarming negatively. It almost seemed impossible how many they had. So check this out. Fidelity had about 120,000 people who had 401ks with over $1 million in it in 2017. 2017 may seem like a lifetime ago to you. I know it does to me, but it really wasn't that long ago. 2017, 7 years. So about 120,000. Guess what they have today? How many 401k millionaires? They've got 500,000, 500,000 in 2024. Whoa. This article explains the number one way Americans become millionaires isn't through timely real estate purchase or being early investors in startups. Boy, doesn't that get us distracted, though. The formula is much simpler. Consistent buying, usually in the form of automatic contributions from every paycheck into a retirement account. Wah, wah, wah. But it's so boring. What will we tell our peers at the water cooler? You'll tell them nothing. You'll have nothing to show. The investing world is full of distractions. It's easy to get tripped up. Rising markets often invite bad behavior. Yep. With some investors making no point of differentiating between the stock market and a casino. They give a great example. There is a leveraged and inverse exchange traded funds which surge in popularity. There are now more than 200 leveraged and inverse ETFs in the marketplace, managing $100 billion in assets. Yowzas. These are leveraged, so debt is used on these exchange traded funds, and inverse, meaning you want the exchange traded fund to move in the opposite direction of the asset that it's tracked. All that means is complexity, right? The investing simple thing went out the window. So check this out. A recent Bloomberg story highlighted one of these investment strategies vehicles that is designed to give investors 3 times the daily return of MicroStrategy. Okay, so check out the machinations that the marketplace has provided for the investor. It ain't good. MicroStrategy. It's not enough simply to own this stock, you see. You must own a stock, an ETF that magnifies the return 3x on the daily basis. Wow. I need to interview whoever is investing in that. So check this out. MicroStrategy stock is up over 100% this year, yet the product that provides 3 times leverage to its stock price is down more than 80%. What? MicroStrategy is a company that basically holds Bitcoin on its balance sheet. It does other stuff, but effectively that's why people own it. It's for its Bitcoin holdings. It's up 100% this year, and yet the product that's supposed to 3x it, 3 times leverage, it's down more than 80%. Complexity, friends. Complexity. We always talk about the danger of complexity. So the way these leverage funds work, these are designed for short-term traders, not long-term investors. So they deliver multiples of daily performance. But unfortunately, over time, the compounding effect of daily resets, destroys returns. So it destroys it. Who knew leverage in short-term would destroy? He who gathers little by little will prosper, but wealth gained hastily will dwindle. So this article rightly highlights the differences between the person that looks for this 3x ETF with MicroStrategy using leverage and the person that just hammer nail, 401k millionaire. Just boring, yet effective. And the article ends with a line that I could have written myself. The best investing may not always be thrilling, but that's for the better. It's for the better. If you try to alleviate your boredom with investing, no bueno. No bueno. Not only will you do poor on your investing, over time, it really isn't that great a solve for your boredom. Doesn't work. And in closing, we got to talk about the Federal Reserve because everybody's talking about it. I've noticed as I kind of walk around throughout my daily life, this must have caught the conscience of Americans because I've had multiple people talking about the market's action as a result of the Fed reserves. And I was proud of myself, listener. I know this isn't supposed to be a podcast where you speak congratulatory nothings about yourself, but I was proud that I didn't actually know what the stock market did. I was getting, people were telling me, the market went up and down, and it was up a lot in the pre-market and all that. I didn't know. Of course, I found out later. I checked it eventually, but that was progress for me to not actually check or care because it doesn't matter. It just doesn't matter. And by the way, on a 1-year chart or a 10-year chart, you're not going to be able to see. If I told you, go ahead and find where the Fed cut 50 basis points, you're not going to be able to find it. It's all going out in the wash, So we do have an article Joe Pinsker and Elisaveta Galkina wrote, Where to Put Your Money After the Fed Rate Cut, what lower rates mean for the trillions of dollars in CDs and high yield savings account. So this article was written just before. Oh no, they must have edited it. No, it reflects that they cut half a percentage point. So this article incorporates it. I guess the electronic versions of these articles get edited. That's interesting. I thought when it came out they hadn't incorporated that. But yeah, this article was aware they cut it point. Oh, they updated the article. There we go. 0.5%. And they are highlighting the need for you, the investor, to be wise, and that you can't just presume that your online bank or your traditional brick and mortar bank is going to give you the best rate, particularly in a rate changing environment. So the landscape, listener, what usually can happen is when rates are just steady, when they're static, they're not moving, the competition for who's offering the best rates pretty well settles out. You kind of know who's on first and if your bank's offering you a good rate or not, and you can move money accordingly. When rates are moving, there's a little bit of dust in the air. Certain players will stick it out, try to grab more assets. I like when people don't have to make a bunch of moves. So I believe in cash management programs of permanence rather than optimization. This is one of those areas where strategic mediocrity is permissible. That's a phrase Morgan Housel coined that I love. But what's going to happen here is, I don't know how far rates will go down, but you are going to see the various banks pull back on rates and at different paces and different levels. So this article talks about various individuals who feel like they timed their CD purchase or their 4-month treasury purchase or whatever. But ultimately, those short-term cash yield strategies are going to go away because the rates are going to go back down, and you're always going to have to step up and find the best way to invest your cash. What do I think the simple, easy answer is? To me, you find yourself a bank where you like the service, you like the location, you're agnostic to the interest rate, and that's where you keep your basic checking. This is if you're looking for the easy way. You can go in there, get checks, whatever. Some people can just do online only. But for me, I'd like to do that. And then for your cash management, find a way to keep it at a brokerage account in a money market fund. Now, that money market fund is going to rise and fall based on the changes of interest rates, but you're almost pretty well assured it's going to be in the top 10%, maybe top 5% of what an equivalent online bank would offer. So instead of having to jump around, this article talks about folks having to jump around and find the right CD, find the right bank, find the right way to park this cash. Just find something you can stick with. That'll be pretty good, but that doesn't involve a ton of work. I thought there was a great example here of Matt De Silva. He's a 30-year-old in New York. He's holding $50,000 in cash. He thinks it's about $30,000 more than he needs. He says this quote, "I've increasingly accepted that it's okay not to squeeze every dime out of my investments," said De Silva, who works at a healthcare software company. "As long as I do the big things right, I'll probably do well enough." I think that's well said. So don't get too obsessed with maximizing the perfect interest rate all the time. Be obsessed with keeping your costs low, keeping your investing simple, and keeping your time horizon long, because that's what's going to give you the best shot on your investing journey. Until next time.